Hey everybody, it's Jay Glazer, and we're bringing you another episode of Guidance by Glazer. Episode 11. Episode 11, everybody. We are here. We are front and center. It's Cash Fridays on the Glazer team. Woo, we're getting crazy. And today we are talking about the 5 must-know facts about a financing contingency. I would bet a lot of you don't even know what a financing contingency is. So believe it or not, that is fact number 1. I have no idea if there's filters on me right now. Judging by Peter's ridiculous laughter happening behind the camera, I'm assuming I'm having this conversation with you under the guise of certain filters. I don't know which filter is on, but let's just go with the flow. So, we're going to talk about financing contingencies, as I said. So, fact 1, what is a financing contingency? It's a clause in the contract of sale permitting the buyer to terminate the contract if the loan fails. What is happening right now? So, as we move right along, it's a clause in the contract of sale permitting the buyer to terminate the contract if the loan fails. How can I do this video if there's all these ridiculous filters on me? Woo! Moving right along. So, just because you assume as the buyer that you have a great credit score and you have good assets, you have good income, all of those things are really important in getting a loan, but that's actually just the tip of the iceberg of when you need to obtain a mortgage. So in a contingency, the contingency actually covers your ability as the buyer, as the creditor, to get the loan, but also building approval and appraisal approval. So there's actually 3 major pillars to getting a loan and that the contingency covers. So as I said, when you have great credit, when you look like a great profile, that's an amazing piece to have already checked off, but you also have to ensure that the building is financeable, which is a big unknown going into it. And once you go into contract, whether the property is going to appraise out. We had an appraisal done today for one of our properties, and now we're going to sit and wait and hope that the contract price and the appraisal price match so that the loan doesn't have any issues. And if the appraisal doesn't come back, the contingency covers you in the event that you have problems with the appraisal. So that's another piece of information that a lot of people don't know that's really important when it comes to financing contingencies. I think I'm dancing right now. I hear music. What's happening? Okay, moving right along. You are usually given around 30 to 45 days to attain a commitment letter, and that's with your financing contingency. So it's the bank's acknowledgement of funding the loan. So within those 30 to 45 days, the bank is going to give you a piece of paper called the commitment letter. The commitment letter is the bank's commitment to you as the applicant and purchaser of the home getting the loan. But there's a difference between the commitment letter and actually showing up at the closing with a check. So again, a lot of people assume that if they have a financing contingency, they're protected through and through. That is not actually correct. When the commitment letter is issued, the financing contingency goes away, and therefore the deal becomes very hard, meaning it cannot be backed out of. So if you get your commitment letter and then a week before the closing you lose your job, or say the markets crash, which happened obviously in September 2009, it's very possible that the bank redacts the loan. So just because you have a financing contingency and then just because you have a commitment letter doesn't mean the bank is going to show up at the closing with the money. So bear that in mind as well. In many ways, a financing contingency doesn't actually get you all that far because you really want the approval and the security going into the actual day of closing when the bank will show up with a check towards the purchase of the home. And that speaks to what is called a funding contingency. A financing contingency and a funding contingency are actually quite different. Now, I don't see many funding contingencies on the sales I work on. I'd like to see more in protecting of my buyers, but quite frankly, they're very hard to weave into funding coverage no matter what. So what that means is if you are purchasing a home and day 1 the bank decides to withdraw from the loan, you're protected. But it also means, as I said, unlike a financing contingency, if day 45 happens and you're 1 day away from closing and all of a sudden the bank redacts the loan, you have the funding contingency. So you actually have the coverage and protection you need to ensure that you're going to get your money back. All right, the contingency is simply language that protects you from the deposit that you've exposed yourself to, the 10% deposit when you sign the contract, right? That's the collateral, that's the security the seller has saying, hey, I'm in this deal, I have 10% of your money, therefore if you decide to back out of this transaction, I get to keep your funds. So that's really a way to protect yourself, is to obtain the funding contingency to ensure that no matter what, without fail, whatever happens, as long as you can have that in the contract, If the bank doesn't have the money for you, you're in the clear. As I said, that's usually a very rare situation, circumstance, because ultimately, obviously it exposes transactions are oftentimes viewed as the easiest, not just because they're cash and obviously someone has the money readily available, but also because there's not all these complications involved with a bank. Sorry for all you bankers watching out there, sometimes cash is king, and it can be easier. So this is my fifth fact, and this is kind of a little bit of a secret and something I think is worth it for people to know. It's kind of what I call brokering 401. It's a little bit more complex, and quite frankly, let me disclose that I am not an attorney, therefore I cannot give legal advice, and therefore what I'm about to say is not attorney confirmed. Having said that, it's my opinion about financing contingencies, and that is financing contingencies are a bit of a farce, right? They don't really do all that much, and here's why. If you have a financing contingency, if you don't have a financing contingency, so you're exposed, so to speak, and you go into contract, and you're in contract for a month, and all of a sudden, the bank doesn't give you the financing for whatever reason. Maybe, like I said, the bank goes under, or maybe you lose your job, or maybe you leased a Ferrari because you had having a midlife crisis. I probably will lease a Ferrari next year. But maybe you lease a Ferrari and you're having a midlife crisis and you have really bad credit, and then the bank has to repull your credit because your credit expired, and all of a sudden your credit score changed and the bank says, whoa, you can't get a loan. Whatever the reason may be. The reality is if you don't have a financing contingency, it's not like the owner is somehow instantly going to claim your 10%. What happens is you get locked up in a lawsuit. So nobody wants to be in a lawsuit unless you're the President of the United States. Boom! Got political. Sorry, I take it back. Nobody wants to be in a lawsuit. And the reality is the seller doesn't really want to either, whether they know it or not. And the reason they don't want to be in a lawsuit tying up your 10% is because that means they can't sell the home to somebody else. If there's litigation on the property, which in that case there would be, that means that owner can't really try to move on to buyer number two. And the reality is does an owner want to be in contract trying to claim your 10% deposit, or do they want to move on with their life and sell it to buyer number two? So the reality is, even though that is not a legal affirmation of any kind, and that's not legal advice, I don't think most owners want to tie up their property for a year, 2 years, 3 years in the court system and the legal system to ensure they're going to get your 10%. They want to say, screw that buyer, let's move on with our life, and let's go find somebody else. So if you don't have a financing contingency, the dirty little secret is it's probably okay. And quite frankly, if you're making an offer in a competitive bidding situation, you look like a better applicant and offerer when you don't have said contingency. So it's a little bit complex. As I said, brokering 401, we know a lot about financing contingencies because, quite frankly, we represent a ton of buyers on the Glazer team, so we can really walk you through the nuances there. I'm sure comments are rolling in about all of the wonderful things that I appear to look like in this video. We're going a little wild today. Cash Fridays, everybody. It's also Cash Video Fridays, evidently. So that pretty much ties us up for the day. I'm going to bring you some more value next week. Please drop some comments. I'm not wearing a sweater today. This is a jumper, so all you sweater haters out there, we change it up. Thanks for joining us on Guidance by Glazer, and we'll see you next week. Cheers.